Hi, this is Mark Item from HONU Trading with the weekly review for the week beginning April 24th, 2023. First of all, a disclaimer. This is for educational purposes only and not recommendations to buy or sell. Know your time frame and risk tolerance. Now, I've got the different time frames listed down below, and this is one of the reasons I'm not going to talk too much about individual stock setups. I like to be a swing trader. I like to hold things a few days to a few weeks. Your time frame may be different. Never forget that job one is risk management. You can follow me on Twitter at HONUMGMT, HONU Management. And if you find my content valuable, take a moment to like and subscribe. Now, our theme this week, it's a market of stocks. It's not one big monolithic stock market. And we're going to examine that by looking at the cap-weighted indexes, S&P 500, NASDAQ 100, as measured by their ETFs, the SPYs and the Qs. Now, these are dominated by the large capitalization companies, the Microsofts, the Apples, the Amazons, the Googles of the world. And you'll see those material again because all four of those report earnings this coming week. But we're going to compare those to the more equally weighted indexes, the S&P Mid-Cap 600 and the Russell 2000 Small Cap. Now, these are equal weighted indexes, so where no one stock dominates. So I'd like to be a bull still, but the breadth, particularly as measured by the smaller equal weighted indexes, just isn't pulling its weight. But the summary for the week, I'll quote Shakespeare, much ado about nothing. So here's a weekly chart, or I should say a chart for the week. Each one of those bars represents 15 minutes, and we're just looking back at the last 5 days. When we look at the weekly charts in a moment, you'll see that this is overhead resistance going back quite a while, and you'll sense a theme, chop fest. Now, on Monday, we opened right about the same place, chopped lower, then had a sharp rally. The next day, Tuesday, gapped higher, failed, and chopped the rest of the day. Wednesday was a gap down and rally, then a chop fest towards the end of the day. Now, Thursday, we wound up almost exactly where we started, but what a journey. Gap lower, rally hard, fail harder, rally back at the end of the day. And then last week on Friday was options expiration, which used to be known for quite a bit of volatility, but last week didn't have much at all. So Maximus is still in the house. Are you not entertained? All right, for today's education segment, we're going to talk about anchored volume-weighted average price. Now, that's a mouthful, and it was created by Brian Shannon. And a few months ago, he literally published a book on the topic. Now, in technical analysis, we only have two raw data points. We have price and we have volume. Both of those are measured through time. AVWAP, as it's called, blends all three of these. And we're going to look at one way to use it today to anchor your volume-weighted average price, and think of that as a moving average modified by volume. So high volume has more of an impact than low volume. But we're going to anchor it to the key highs and the key lows. Now, Brian would want you to know that it's pronounced AVWAP, not AVWAP. So let's look at the big cap indexes and compare them to the equal weighted indexes. We'll also take a look at the ratios between the equal weighted S&P 500 ETF, RSP, compared to the SPY, and the equal weighted Qs, QQQE, related to the cap weighted Qs. So here we'll introduce the concept of AVWAP. The green line is the AVWAP from the all-time high in November. This is a weekly chart, so this goes back well over a year to early last year in 2022. Had been support, broken, and has now become resistance. Now, on the positive side of the ledger, we've had 4 consecutive weeks close above that AVWAP from the highs. On the negative side, price has rallied fairly sharply, volume has fallen off, and the last 4 weeks have all been below average volume. And we're seeing exactly the same thing on the Qs. 4-week closes above the AVWAP from the highs. And in fact, the Qs are a little tighter. The open and the close 4 weeks ago has completely encompassed all of the price movement in the last 3 weeks. Now, we're going to break some way, one way or another this week, with 4 of the top 10 cap-weighted NASDAQ stocks reporting. But we have the same thing going on here. Price rising, volume falling. Now, compare this and contrast it, if you will, to the mid-caps, which are not above the AVWAP from the highs. Now, the mid-caps are above the AVWAP from the lows and have been for the last 4 weeks, but the same concept of price and volume. It's the small caps, the Russell 2000. Now, this hasn't even gotten above the AVWAP from the lows, let alone the AVWAP from the highs. Now, the small caps and mid caps, small caps especially, do have a lot more exposure to the banks, and we're going to take a look later at the financials. So the ratio of the equal-weighted S&P 500 to the cap-weighted, that's really fallen out of bed this year. It had gotten a little bit elevated into the end of the year, but has fallen out of bed this year. Same thing with the equal-weighted Qs to the cap-weighted Qs. Financials, let's look a little bit deeper. They're not out of the woods yet, and like I've said for the last few weeks, that 30 level better hold. So 30 is an important level. It had been resistance going back to actually before the great financial crisis in 2008. So with the XLF, we've had another week of higher prices and average to slightly below average volume, nowhere near what we had during the sell-offs. Now, the top stocks in the XLF include things like Berkshire Hathaway and 2 that report this week, Visa and MasterCard. And those don't have any kind of real credit risk. Berkshire Hathaway has insurance, but they also have large positions in Apple and Coca-Cola. Visa and MasterCard don't have any direct exposure to credit risk. They just process transactions. So when we look at the big bank index, KBE, that has fallen and has not gotten up. It's threatened the high from about 5 weeks ago, but hasn't broken through yet. Look at the volume on the sell-off compared to the recent and actually average volume. But the regional banks are actually worse. No real change. They've actually threatened the lows for the last 3 weeks. Haven't broken down yet, but we'll see what happens in the coming weeks. Still a lot of financials to report. Bond market has gotten tamer. I'm just going to show the daily chart of the 2-year Treasury. We don't have these wild up and down moves like we had earlier in March around Silicon Valley Bank. It's tamed down quite a bit. I may not even mention it much in the weeks ahead. And finally, earnings season continues for real this week. We've got 4 of the mega cap techs, 7 of the Dow Jones Industrial stocks, and 2 of the top 4 in the XLF. So the code is yellow arrows are the Qs, white arrows are the Dow, orange arrows are the 2 in the XLF. Let's look at those first. You've got Visa that reports Tuesday after the close, MasterCard Thursday before the open. In the mega cap tech, you've got Microsoft and Google, Facebook or Meta, and Amazon all reporting Tuesday, Wednesday, and Thursday after the close. Now the Dow stocks, the Dow is a price-weighted index, so the higher price stocks like McDonald's and Boeing have a greater impact. While Intel's a Dow stock at $25, it could move $10 and not have any move in the index, but what's the likelihood of a $25 stock moving 10? Whereas a $300-ish stock like McDonald's could move 10 points in a day. So we've got Coke, McDonald's, Boeing, Merck, Amgen, Intel, and Chevron all reporting. So to sum everything up, again, it's a market of stocks, not one big monolithic stock market. Take a look at the anchored volume weighted average price. If you look at Brian's channel on YouTube, he's got a lot up there. There's a lot of other people who've done more in-depth videos on that as well. Earnings season, get ready. You probably will be entertained this week. Take care, trade well, and make it a great week.